Is good evening, everyone. Good evening. How are we all? Which one you should message me? You should message me. 1 second. Let me just rename it. Yeah. Okay. Yeah. So the name where you see my full name, you can message me on that. Okay. So good evening, everyone. Good evening. Good evening. Good evening. So where were we in the last class? Where were we in the last class, guys? Okay, so now, am I audible properly? Just change the device. Perfect. Is the audio voice? Is the audio clear? Everyone? Can you hear me, guys? Please confirm. Can you hear me? Yes, audible? Okay, perfect, yes. Then let's go for the topic ratio analysis. I think in the last class, we had started with the topic of ratio analysis, correct? So we have done a few topics, few ratios. Let me just quickly recap those ratios for you. And then probably we will take it forward with further more discussion about the ratios in today's class. So probably we'll be completing all the ratios in today's session. Then in the next class, we'll be doing the practical questions on that. Now, coming to the ratios, we initially started with the ratio called as current ratio. What was current ratio, guys? Formula for current ratio. It was current asset upon current liabilities, right? And obviously, as the current ratio is high, so say high current ratio means high liquidity or high short-term liquidity. High current ratio means high short-term liquidity, but very high current ratio also means inefficiency. Very high current ratio means inefficiency. So inefficiency in a sense that very high current ratio means inefficiency. That could be due to if you have selling inefficiency, right? If you are having good, if you're having high level of stock, it will also indicate uh, like investment inefficiency, right? Because if you're having good amount of cash but you're not able to invest it, you're facing the investing inefficiency. Then you can also say that there is, if you're having high amount of debtors in your books, that indicates collection inefficiency. That's the current ratio. So ideal current ratio we had stated, ideal current ratio should be 2:1, right? Then we just took it forward with the another ratio, that was quick ratio or acid test ratio or liquid ratio. So we had quick ratio as equal to current asset minus stock minus prepaid expenses divided by current liability. And then absolute liquid ratio. Absolute liquid ratio will be cash and cash equivalents, right? Plus marketable securities divided by current liabilities, right? That was the absolute liquid ratio. After that, we went ahead and started looking at some more set of liquidity ratio or short-term liquidity ratios, which was basic defense interval, right? So basic defense interval ratio. How do we determine the basic defense interval? That is going to tell us for how many days do we have the cash available in our books or quick assets available in our books. So we take quick assets divided by daily operating expense. So daily operating expense is basically, how do we get the daily operating expense? By the way, daily operating expense will be, okay. So basic defense interval ratio was quick assets upon daily operating expense. So daily operating expense will be the COGS number, because COGS is definitely your daily operating, I mean, it's part of your expenditure. So that's going to be COGS, right? Plus all other expenses also. Yeah, other expenses will be like admin expense plus selling expense minus depreciation upon 365. Okay, so that's a basic defense interval ratio. COGS plus admin expense plus selling expense minus depreciation upon 365. That's your basic defense interval ratio. Okay. Now, after that, we started with some of the long-term solvency ratios, right? Long-term long-term solvency ratios. Can you name few long-term solvency ratios, guys, that we have done? Can you name few long-term solvency ratios? Just revising the stuff that we have done in the last class. Equity ratio. Well, equity ratio is equity shareholders' funds upon net assets, right? Then we have another ratio called as debt ratio. Debt ratio is going to be total debt upon net assets, right? That your debt ratio. Then proprietary ratio. Proprietary ratio. Proprietary ratio will be equity share capital plus reserves plus preference share capital, because we are talking of owned funds over here, upon net assets. That's your proprietary ratio. Then we have another ratio called as debt equity ratio. Debt equity ratio was debt funds upon equity shareholders funds, right? After that, we have also seen one more important ratio called as capital gearing ratio. Capital gearing ratio will be funds requiring fixed rate of return upon funds not requiring fixed rate of return. Now, which are the funds that require fixed rate of return? Funds which require fixed rate of return, that is debt plus preference share capital, right? So these are the two type of funds that do not require the fixed rate of return. That requires a fixed rate of return. So this debt plus preference share capital, and then we divide it by funds which do not require fixed rate of return. That will be equity shareholders funds. So high capital gearing ratio indicates higher risk for the company. Okay. Then also your solvency is going to be looked at by looking at another set of ratio called as coverage ratio. Okay. So coverage ratio, there are multiple coverage ratios by the way. The multiple coverage ratio. First is interest coverage ratio. Interest coverage ratio will be EBIT upon interest. Right? Preference dividend coverage ratio. That will be preference dividend upon, sorry, not preference dividend, PAT upon preference dividend. Then we had the debt service coverage ratio, right? Debt service coverage ratio. The debt service coverage ratio will be available for debt service, earnings available for debt service divided by interest plus principal, or interest plus principal. We're talking of principal due, right? So now, how do we get these earnings available for debt service? Earnings available for debt service will be computed as PAT. That you add interest, plus to that you add depreciation, right? And add non-recurring expense minus non-recurring income. So all those non-recurring items we are going to exclude from our calculation. Okay. A simpler version of debt service coverage ratio is fixed charges coverage ratio. Fixed charges coverage ratio is EBIT plus depreciation upon interest plus principal due. So basically, denominator is remaining the same, but it's not. The numerator is not that much detail, but rather it takes simple term EBIT plus the depreciation portion. Okay, so we have done this coverage ratios. I think this is the set of ratios that we have done till now. Correct, guys? We have to start with the next set of ratios now. Correct, guys? We have completed till picture, till this coverage ratios. Correct, guys? Shall we proceed with the next set of ratios now? Okay, then let's go for the next set of ratios, which are also called to be the activity or efficiency or performance, or also said to be turnover ratios, right? And coverage ratio not explained. I've explained that all these coverage ratios are going to be telling you how efficiently or how good you are in, how secure you are in paying the interest and other charges. So I think that is what we have covered already. Right now, we are looking at the next set of ratios. From here, our current or today's discussion is going to start. So this activity, efficiency, or performance or turnover ratio is going to tell us or to measure how actively company is utilizing its assets. It is going to measure how actively the company is going to utilize its assets. Okay, so we have S and P. So let's say we have got two companies. Now, these companies are definitely going to tell us how actively we are going to utilize the assets. So let me just take an example. Suppose for these two companies, S and P, we have a sales. Let's say here it is 12 lakh, here it is 8 lakh. And the total assets the company has is 2 lakh. Total assets is 2 lakh for both the case, both companies. Now, can you tell me, out of these two companies, which company is utilizing its assets more efficiently? Can you tell me which of these two companies, is actively utilizing or utilizing the assets in a better manner as compared to the other? Which of these two companies are better at utilizing the assets? Company S. Why so? Why would you say that company S is utilizing its assets in a better way? More sales. Or can I say you're thinking in those lines that with 2 lakh total assets, company S is able to generate 12 lakh of sales, whereas company P is able to generate, 8 lakhs of sales, right? So if I ask you one question, how much sales is generated for every rupee one of asset? How much sales is generated for every rupees one of asset? For every 1 rupee of asset, how much sales have been generated? Or I can put it the other way around also. How many times of assets is the amount of sales? How many times of assets is the amount of sales? And so for S, it is 12, it is saying 6, and here it is 4, right? How do we get this 6 and 4? How do we get this 6 and 4? Of course, this is more active. This one is less active. Company S is more active, company P is less active. So now just tell me, how did we get these numbers? Total assets turnover. If I ask you, what is the total assets turnover, or how actively it is being generated, can I say you just did it like this? Sales upon total assets, right? I can actually refine it. A bit by simply stating that okay, I'll just take this instead of sales. We can also have this ratio based on COGS. So that will be specified in the questions. So you need not worry, because sales or COGS, whatever is the number, that will be specified in the question. Now, instead of writing total assets, my question is, which total assets should I consider? The opening amount of total assets or the closing total assets? Which total asset value should I consider? Opening or closing? Yep, opening or closing. But rather, instead of taking opening or closing, instead of debating whether I should take opening or closing, can I say, let's work on simple average total assets. Concept. Okay. So total assets turnover can be sales or COGS upon average of total assets. Okay. Now, after total assets turnover, if I same way ask you, what should be the fixed assets turnover? How do we get this fixed assets turnover? Can you tell me, guys? How do we get the fixed asset turnover? Sales upon average fixed assets. Perfect. Absolutely correct. So that's going to be sales upon average fixed assets. Okay. Or you can also say that this is going to be sales or COGS on average fixed assets, right? Um, so this is going to be like, if it's total asset turnover, um, what should be the rule? Should it be like higher the better or lower the better? Total assets turnover, should it be like higher the better or lower the better? It is obviously higher the better, as it indicates higher level of efficiency. What about fixed asset turnover? Fixed asset turnover, again the same thing. Higher the better, because it is going to indicate higher level of efficiency or more active use, right? The turnover means how many times of your denominator is the numerator. Okay. Now, same way if I ask you, what will be total capital employed turnover? Total capital employed turnover. This is going to be same way sales or COGS divided by average total capital employed. Okay, so can I say all these turnover ratios have got a standard form? Standard form of turnover ratio, sales or COGS divided by so sales or COGS divided by average of X. Now that X can be anything, right? It can be capital employed, it can be working capital, it can be current assets, or it can be any other. Okay. Now some of the important turnover ratios we have already seen. These numbers are going to indicate how actively or efficiently they are being utilized. Uh, the next important ratio that we're looking at is in depth. We're going to look at three ratios in depth: inventory turnover ratio. Now let's look at this inventory turnover ratio. Suppose there are two companies, W and Y. Okay, they have got a COGS of 9 lakh and 10 lakh. Okay. Okay. There's some technical issue anyways. Okay. Okay. Let's get started with. Yeah. So COGS, let's say for company W is 9 lakh and for company Y is 10 lakh, and we have the average stock. We have the average stock as, let's say, 3 lakh and 2 lakh. Okay. So COGS is 9 lakh and 10 lakh. Average stock is 3 lakh and 2 lakh 50,000. So each of these two companies, do you feel like, uh, which of these two companies are doing better or utilizing the stock in the better way? So these two companies, do you feel are utilizing the stock in a better way, W or Y? Hmm? Which of these two companies are utilizing the company in a better way, W or Y? So my question before you answer that is, how many times of stock is the COGS? How many times of the stock is COGS? Can I say here it is 3 times and here it is 4 times? Right? So this three over here, this three simply means uh, company generates rupees 3 sales using rupees 1 as is one stock or inventory we can say. Right? So using 1 rupee inventory, you're able to generate 3 rupees stock or 3 rupees sales or COGs. Right? And whereas in case of W, it is 4. Of course, which one is more efficiently utilizing utilizing the stock? It is the company Y, which is utilizing the company in the best possible way, right? The company Y is able to generate returns in the best possible way. The number of months which are required to sell, I mean, the Y is having 4 times COGS as that of average stock, and W is having 3 times COGS as that of stock. Okay, yeah, right, guys. So, or I can say, we can also look at it in another way that company sells 3 times of its stock, or basically company sells 3 times of its stock, and company Y sells 4 times of its stock. Company W sells 3 times of its stock, and company Y is going to sell 4 times of its stock. Okay. So obviously, company Y is utilizing the stock in a better possible way, right? Now, if I ask you that since the inventory turnover is 3 or 4 times, so in 1 year, we are able to generate 3 times or 4 times of the stock as sales. Uh, if I ask you what is the number of months required to sell one lot of inventory? In case of company W, can you tell me what will be the number of months that will be needed? What will be the number of months that will be needed to sell one lot of W? How many months? Can I say there are 12 months in a year and there is 3 times the sales? I mean, 3 times of the stock is COGS. So 12 by 3. 12 is the total months, and in that tenure of 12 months, 3 times is the stock. And the COGS is 3 times of the stock. Suppose each lot of stock is being sold in 4 months, right? And here you can say it is 12 divided by 4, which is 3 months. 12 divided by 3, 4 months, and that's another side 12 divided by 4, 3 months. So number of months required to sell one lot of inventory is 4 months and 3 months. And this is what we call as inventory in period. So to put it way in a simple format, formula wise, we can say inventory turnover. How do we calculate the inventory turnover? How do we calculate the inventory turnover rates? Can you just put it in the form of a formula? How do we get this 3 and 4? How do we get this 3 and 4 times? So inventory turnover formula, absolutely correct. That's COGS upon average stock. Inventory turnover is COGS upon average stock, right? And what can be the formula for inventory holding period? Inventory holding period will be inventory holding period will be 12 or 365 or 52, depending on it is months, weeks, or year or days. Okay? That's divided by inventory turnover. 12 or 365 or 52 divided by inventory turnover. You can just rearrange it a bit. So the numerator is 12 or 365 or 52. But we divide it by, instead of saying inventory turnover, you can definitely say that this is COGS on average stock. You 12 or 350, 12 or 365 or 52 upon COGS, right? Divided by, it was average stock. Inventory holding period will be like 12 or 365 or 52 multiplied by average stock on COGS. Okay, did you get this, guys? Okay, so that's the inventory turnover and inventory holding period. Now, after this after inventory turnover and inventory holding period, next is on the similar lines, we have another set of turnover ratios, uh, which is debtors turnover. By the way, inventory turnover, all the turnover ratios are always higher the better. If so higher inventory turnover means the ratio is better. What will be the value of debtors turnover? Debtors turnover will be credit sales upon average receivables, right? And remember, receivables is going to include receivables will include even the bills receivable. Receivables will is also going to include bills receivable. Okay. So average, whenever we say denominator is average, average is nothing but you take the opening and closing and then divide it by 2. The average stock is basically average, I mean, opening inventory plus closing inventory divided by 2. Right? So debtors turnover, this is going to tell us how many times in a year collection or sales happen to, how many times in a year collection or sales happen to, happen with, we can say, debtors. Debtors turnover is credit sales upon average receivables. So receivables is going to include the bills receivables, and this is going to tell us how many times in a year collection or sales is going to happen with the debtors. Right? Now, any idea what should be the days that we want to look at? Like suppose if you want debtors collection period, debtors collection period. How do we calculate the debtors collection period? Debtors collection will be 12 or 365 or 52 divided by average debtors. Okay, 12 or 365 or 52. Sorry, not debtors. That's going to be divided by debtors turnover. 12 or 365 or 52 divided by the debtors turnover. Okay, so debtors turnover is going to be calculated, debtors collection period. Now, debtors turnover is always going to be higher the better, and collection period is always going to be lower the better, because it's better to collect that. I mean, it's better always to collect earlier from your debtors, right? Now, same way, if I want to calculate the creditors turnover, can you tell me what will be the formula for creditors turnover? Can anyone tell me what will be the formula for creditors turnover? Take a cue from the debtors turnover. How do we calculate the creditors turnover? Hmm? Okay, perfect. Credit purchases upon average payables. Yes, that's going to be credit purchases upon average payables. Creditors turnover is credit purchases upon average payables, right? And if I ask you what should be the debtors payment period, I'm sorry, creditors payment period, creditors payment period will be 12 or 365 or 32 divided by creditors turnover, right? Yeah. So that's your creditors payment period. So it should be debtors turnover upon 30 days, 12 months. Is it right? 30 days, 12 months? Dhanush, what are you saying? Debtors turnover upon 30 days or 12 months? So numerator is going to be the number of days, weeks, or months. Then you divide it by the turnover number. Okay, so all the turnover ratios, as I said, they are always having this particular format. Sales or COGS upon average of that. If you have like debtors, denominator is going to be average of debtors. If it's creditors, denominator is going to be average creditors, right? Creditors payment turnover, lower the better. Payment period is higher the better. Yes, perfect, Jayendra. Correct, Jayendra. In case of creditors turnover, it's going to be lower the better, and payment period is going to be higher the better. Okay, these are our turnover ratios that we were discussing of. Now we'll go to profit and loss ratios. All our profit and loss ratios are always going to be of the general form. Generally, you will find the profit and loss ratios to be X upon net sales multiplied by 100. General form is going to be X upon net sales multiplied by 100. So if you want to know what is the gross profit ratio, it's going to be gross profit on net sales multiplied by 100. Gross profit upon net sales into 100. That's your GP ratio. Then we have net profit ratio. The net profit upon net sales into 100. Net profit ratio is net profit upon net sales into 100. Now remember, net profit over here, it means profit after tax, or it can be sometimes also used PBT, right? So all these are going to tell us what percentage of sales is gross profit, what percentage of sales is net profit, right? All these are going to be in those particular line. Okay. So gross profit ratio, then we have the net profit ratio. Same way we have operating profit ratio. Operating profit ratio is computed as EBIT upon net sales multiplied by 100. Right? Because as I said, EBIT is denoting the operating profit number. EBIT is the operating profit number. EBIT upon net sales into 100. COGS ratio. COGS upon net sales into 100. Okay. What is EBIT? Earnings before interest and tax. EBIT is earnings before interest and tax. Okay, can anyone tell me this COGS ratio? I can also write it as 100 minus some ratio. What is it? 100 minus which ratio is going to give me COGS ratio? Can anyone tell me? Cost of goods sold ratio can be derived as 100 minus which ratio? Yes, 100 minus GP ratio. COGS ratio is 100 minus GP ratio. Okay. COGS ratio, then you have operating expense ratio. Operating expense ratio, because your GP is basically your sales minus COGS, right? GP is sales minus COGS. So therefore we say COGS ratio will be 100 minus GP ratio. Operating expense ratio. Operating expense ratio, that will be computed as COGS plus operating expense upon net sales, that into 100. And when you say operating ratio, we are talking of all the operating ratio, operating expenses. You can understand this as what percentage of sales is spent on operating the business. We're talking of what percentage of sales is actually spent on operating the business, right? Gross profit is not PBT, beta. Rehana, cost profit is not PBT. PBT is after subtracting all your expenses, interest, everything. Okay. Or for that case, if you have any other ratio, any expense ratio, it is going to be that expense upon net sales 200. Generally, if I just put it in the form of a simplified version where we start with sales, less you do the COGS, get the gross profit, right? Then you subtract um, all your other expenses like your admin expense, your selling expense. That gives you earnings before interest and tax. From that, you're going to subtract the interest expenditure. It will give you PBT less tax, which will give you profit after tax. And then from PAT, you subtract uh, preference dividend, which will give you net profit for equity shareholders. Okay, so this is the typical format that we generally prefer to calculate this P&L ratio. Which are operating expenses? This part. COGS, admin, and selling. All these three are your operating expenses. Whether EBIT and PBT? No, you can see EBIT is not same as PBT. EBIT is earnings before interest and tax. PBT is only profit before tax. Okay, fine. Let's look at some of the return ratios. How do we compute the return percentage? How do we calculate the return in percentage terms? Yep. How do we calculate the return in percentage terms? Generally, if I tell you, let's say investment is 3 lakh, income that you have earned is, let's say, 60,000. Investment is 3 lakh, income is 60,000. Investment is 3 lakh, income is 60,000. Can you tell me what will be the percentage rate of return? What will be the percentage rate of return? How much percentage did you earn in this? By investing 3 lakh, if your income is 60,000, what is the rate of return that you have? How much return did we earn? Can I say it's simply 60,000 on 3 lakh? 60,000 divided by 3 lakh, which is 20%, right? So how did we get this? We got this as income on investment. So return percentage will be income on investment, right? So now we're going to look at some of the return ratios, and of course we are going to multiply this by 100 also. So if you want, let's say return in percentage term, return on assets, return on assets will be like we are earning the net profit after tax upon average assets, and then you multiply this by 100. Net profit after tax upon average assets multiplied by 100. Okay, that's the return on assets, net profit after tax upon average assets into 100. Then we have this as EBIT into 1 minus T upon average assets into 100. Sometimes we also take it as instead of taking net profit, both of them are acceptable. Now, which version of the formula is to be used, that will be specified in the question, that you need not worry about. Okay. So return on assets, we say it's net profit after tax upon net assets, or it can be also EBIT based, which is EBIT 1 minus T upon average assets. Now, why do we do this EBIT 1 minus T? That is basically your tax rate. T is tax rate. Okay. T is the tax rate. So, for example, if you have EBIT as 10,000 and your average assets is 40,000, tax rate is T, that is 30%. What is return on assets? What is return on assets? Return on assets will be like 10,000 into 1 minus 0.3 divided by 40,000. Okay. That's 10,000 into 0.7 upon 40,000. 7,000 upon 40,000. That works out to be 17.5%. 7,000 upon 40,000. That's 17.5% is your return on assets. If you take the EBIT. Okay. Same way, if I ask you what is your return on capital employed, return on capital employed will be EBIT upon average total capital employed, and of course multiplied by 100. EBIT upon average total capital employed multiplied by 100. And same if I want to calculate the return on capital employed, but let's say I want to do this after tax. This is after tax, right? Total TC is total capital employed. After tax, when I want to make it, I'll do the same. EBIT into 1 minus T. EBIT into 1 minus T upon average total capital employed. Okay. And that will be again multiplied by 100. EBIT 1 minus T upon average total capital employed into 100. Okay. Then if I want to see what is the rate of return earned by our equity investors, we calculate the return on equity. Return on equity will be net profit for equity shareholders on average equity shareholders fund multiplied by 100. What is T in? T is tax rate. T stands for tax rate. So tax rate is like 30%. So that 30% is obviously written as 0.3. Okay. These are the return ratios which are going to tell us what all numbers, why doing 1 minus T. We are making it after tax, post-tax number, after subtraction of the tax. We are making this EBIT numbers after tax. So net profit for equity shareholders is different because that is computed over here. That is computed by subtracting interest and tax and preference dividend from the EBIT portion. Whereas when you just subtract the tax, we just do this income statement, right? Just do this income statement. All the numbers, all the items that we have are going to be taken from here. Average equity shareholders. Where is equity shareholders? I'm not taking average equity shareholders. It's equity shareholders fund, Baba. The average equity shareholders fund means equity share capital plus reserves. It's going to be average equity shareholders fund means equity share capital plus reserve. We're not taking the count of equity shareholders. Okay. Now, let's look at some of the last set of ratios, which are also set with the market ratios. Now, let us understand this market ratio with help of certain numbers. We have two companies, let's say A and B. Net profit for equity shareholders, let's say 2,40,000 for A and 3 lakh for B. Then we have number of equity shares as 80,000 and 1 lakh 20,000. If I ask you, what is the earnings per share? How do we compute the earnings per share? Earnings per share. If 24, I mean 2 lakh 40,000 is the net profit for equity shareholders for company A, and 3 lakh is the net profit for equity shareholders for company B, can you tell me what will be the earnings per share wise? The formula is going to be net profit for equity shareholders on number of equity shares. EPS will be net profit for equity shareholder divided by number of equity shares, and for B it is 2.5. That's our particular formula for EPS. Now, if I ask you, let's say total dividend paid by the company, total dividend paid by A is 50,000 and 1 lakh. How much did you pay as dividend per share? How much did you pay as dividend per share? How much did you pay the dividend per share? If the total dividend is 50,000, how do we get the dividend paid? Of course, that's going to be total equity dividend upon number of equity shares. Dividend per share is going to be dividend divided by number of equity shares, 0.625, and here it is 0.8333. Right? Now the company has earned 3 rupees, out of which it has paid 0.625. So I want to know what proportion of earnings paid as dividend. What proportion of earnings is paid as dividend? Yeah. What proportion of earnings is paid as dividend? That's called as dividend payout ratio. Dividend payout ratio is dividend per share upon earnings per share. Dividends per share upon earnings per share. Dividend payout ratio. That's going to be dividend payout ratio is DPS upon PS. The dividend payout ratio, you can say it is 0.625 out of 3. and here it is 0.333. Okay, so it's like how much proportion is our dividend payout ratio? We can say 20.83% and 33.33%. Now, if this is the proportion of percentage which is paid out, I would like to know, Rohan, it is number of equity shares, not number of equity shareholders. Okay, so if I ask you retention ratio, retention ratio is basically how much the company has retained. So if company is paying out 20.83%, how much has it retained? We can calculate the retention ratio as 100% minus dividend payout ratio. 100% minus dividend payout ratio. Okay. So in our case, retention ratio, there will be 1 minus this 79.17 and 66.67. Okay. Dividend payout ratio is DPS upon EPS. Dividend pay per share upon earnings per share. And retention ratio is 100% minus dividend payout ratio. Okay. Now we have the DPS and EPS numbers. We look at the market price per share. Company A is having a market price of 12. Company B is having a market price of 18. Okay. Company A is having a market price of 12 and company B is having a market price of 18. A is having a market price of 12 and B is having a market price of 18. Right? So if I ask you dividend yield in terms of percentage, dividend yield in terms of percentage, that will be dividend per share on market price per share multiplied by 100. So dividend yield is basically what percentage of your market price is dividend and what percentage of your market price is earnings. That will be your earnings yield. We have earnings yield also. That's going to be percentage. This is going to be EPS upon MPS into 100. Now these ratios, dividend yield ratio, earnings yield ratio, are going to provide like dividend yield. So dividend yield is like a person who is going to buy this share at a price of 12. Someone is going to buy the share at a price of 12. He'll be getting a dividend of 0.625. By investing 12, he's getting a dividend of 0.625. So how much percentage did he earn? How much percentage did he earn? That's going to be 5.2%. Dividend yield is rate of return in terms of dividend. Dividend yield is rate of return in terms of dividend. Okay, dividend yield is rate of return in terms of dividend. What is the dividend yield earned by company B then? What is the dividend yield earned by company B? And I say it's going to be DPS upon MPS again. That's going to be 0.83. And if I talk of earnings yield, that's called as rate of return in terms of earnings or in terms of EPS. We can say here the company is earning 3 rupees on a market price of share as 12. That's 25%. And here it is 13.89%. These are the rate of return earned by the investor in terms of the earnings or in terms of the dividend. Okay. Are we clear? Okay. Now, an important ratio that we have is called as price earnings ratio or P ratio. P ratio is computed as market price per share upon earnings per share, right? So if we compute over here the P ratio, that will be MPS divided by EPS. Here it is 4 and here it is 7 point. So this 4 means MPS is 4 times EPS in A and 7.2 times in B. Market price to get total dividend 50,000. That will be given in question. Anup, total dividend is an input thing. That will be given to us. Okay. So this is given. This is given. Total dividend will be also given to us. Market price per share will be also given to us. P ratio is price to earning. P ratio is what? Price to earning ratio. This price to earning ratio, we say for company A, it is 4 times, and for company B, it is 7.2 times. So basically, your market price of the share is 4 times or 7.2 times of their earnings. So out of these two companies, which company do you feel has got a greater investors' confidence? Which of these two companies do you think are having a greater investor confidence? Company B, yes. Company B has got a greater investors' confidence because of a simple reason. For 1 rupee earnings, the people are ready to pay 7.2 rupees as the market price. Okay, fine. So these are the ratios that we were looking into. I've covered almost everything. There are few couple of ratios. One is Q ratio and another is price to book value ratio. We'll do it in a short while. Okay, probably not today, but maybe in the next session. So let's just take a break right now, right? EPS is greater, but in spite of EPS being greater, the price is not that higher. Therefore, the PE ratio is less than. So let's take a break now, 2 minutes break, and then we'll come back and maybe start with some numerical exams. Okay, let's take a break, guys. Shall we continue? We're back after the break. Yes. Let's get started with some questions now. We have covered the ratios exclusively. What does P imply? Rohan, P implies the level of confidence. So higher P means higher level of confidence of investors in the company. Okay. So just 1 second. Let me share the questions with you for the ratio analysis. Okay. Can you see the screen? Yes. Okay, so here we have this data available with us, where we are supposed to preparing a summarized balance sheet. Now, whenever we have such ratio questions where we are supposed to prepare a balance sheet, what we should do is we'll first prepare a broad format of balance sheet. Okay, wherein we have got some assets and liabilities part. So let's have a look at what all things do we have in the balance sheet. So in this data, we have got the working capital number. So working capital means we're definitely going to have the current assets and current liabilities. Within current liabilities also, we're going to have bank overdraft of 40,000. Then we have fixed assets to proprietary. Essentially, the amounts that we are going to have over here, one is fixed assets, other is current assets, right? Current assets, working capital is current asset minus current liability, and current ratio is also current asset upon current liability. So we have got the current ratio. Proprietary, in the proprietary funds, we'll have share capital and also reserves. Then current ratio, and we have got the current liabilities also. So let me just write it. Current liabilities. And within those current assets and current liability, I need to provide further description. So in current liabilities, we will have bank overdraft, and then we have others. In the current assets, we have since we are using this liquid ratio, in liquid ratio, we are going to remove the stock. So somewhere or the other, we'll be able to calculate the value of the stock. Then we will say other current assets. Let me just write down the amounts. The reserves and surplus is given as 1,60,000, and bank OD is 40,000. Okay. We don't have any other information. Balance sheet can be prepared in T format or even in the vertical format. That's both the way it is acceptable, and that's fine. Now, this is what the information is. So we need to calculate the amount of fixed asset. We need to know the value of stock, other current assets. We need to know the other value. Then, of course, the total of current liabilities and also share capital. Okay, so let's get started with the first information, working capital. How do we calculate the working capital numbers? Working capital. Working capital is calculated as current asset minus current liabilities. Right? So current asset is something that we don't know, and neither do we know the current liabilities. But we know that working capital is 2,40,000. Now, whenever we have this sort of questions of balance sheet, what we need to do is, along with an amount, just search for a ratio, connecting ratio. Like in working capital, we say it's current asset minus current liabilities 2,40,000. So try to look for a ratio which is having current asset and current liability. Working capital is current asset minus current liability, and then we have the current ratio given to us. Current ratio is current asset upon current liability, and then current asset upon current liability ratio is 2.5. Current assets upon current liability, the ratio is 2.5. Now, how do we go about using these two numbers? Let us simply say that current asset is going to be 2.5 times of current liability. This is going to be my equation number 1. This will be equation number 2. What we need to do is simply substitute 2 in 1. When we are going to substitute 2 in 1, we say current asset minus, in place of current asset, we'll say it is 2.5 current liability minus current liability is 2,40,000. 1.5 current liability is 2,40,000. Then current liability is 2,40,000 divided by 1.5. Current liability is going to be 2,40,000 divided by 1.5. How much is this? 2,40,000 divided by 1.5 is? What's the value of current liability? One lakh 60? Yeah. Okay, so current liability is 1,60,000. This simply implies current asset. Anyways, it was 2.5 times of current liability. That's 2.5 into 1,60,000. 0.5 into 1,60,000. How much is this? What is the value of current asset? 4 lakh. We got current asset. We got current liability. Current asset is 4 lakh. Current liability is 1,60,000. The next ratio that we will use is liquid ratio. Let's use this liquid ratio, guys. Now we know liquid ratio is calculated as current asset minus stock upon current liability. Current asset minus stock upon current liability. And this liquid ratio is given as 1.5. We have current asset as 4 lakh minus stock value is something that we don't know, which we need to compute. 4 lakh minus stock upon the value of current liability 1 60,000 is 1.5. We can say that this is 4 lakh. Four lakh minus stock is equal to 1 lakh 60 into 1.5, which will be, of course, 2 lakh 40,000. So therefore, what will be the value of the stock? What is the value of the stock? 1 lakh 60,000, right? So we got the value of the stock, right? So let me just fill up this balance sheet one by one. We got the value of stock as 1 lakh 60,000. What is the total current assets value? Total current assets is 4 lakh, right? So what number can I designate for other current assets? What number can I say for other current assets? What is the value of other current assets, guys? 2 lakh 40. Right? That's 2 lakh 40,000. Then also current liabilities we have got as 1 lakh 60,000. Current liability is 1 lakh 60,000. So can you tell me what will be the other current liability then? What will be other current liability? 1 lakh 20,000, right? The other current liability is 1 lakh 20,000. Okay. We have used all the ratios except this ratio of fixed asset to proprietary ratio. Let's use that. Fixed assets to proprietary. This is nothing but fixed assets upon proprietary. Fixed assets to proprietary ratio is 0.75. Okay, so fixed assets to proprietary, that is 0.75. Now, what is the value of fixed assets? We don't know. What's the value of proprietary? That also something which we don't know, because proprietary will be obviously share capital plus reserves. This is going to be fixed assets upon share capital plus reserves. We know the reserves value as 1 lakh 60, right? Share capital plus 1 lakh 60,000 is equal to 0.75. Okay. Now this is one of the equation that we are having. This fixed assets is equal to 0.75 share capital plus 1 lakh 20,000. This is the ratio given to us. And then we have also information about uh, funds, reserves, and surplus. The reserves and surplus is already we have accounted for fixed asset to property, and we don't have any other information available. So how do I get now the value of fixed asset and the share capital? How do I get the value of fixed asset and share capital? Total liabilities, yes. Dharni, you're exactly correct. We just need to look at this particular fundamental equation. How 1 lakh 20,000 came. This entire thing multiplied by 0.75. 0.75 into share capital plus 0.75 into 1 lakh 60,000. Got it? So now we just need to look at, total assets. Total assets is going to be fixed assets plus current assets. Fixed asset plus current asset. It is obviously fixed asset plus um, current assets is 4 lakh, right? Then we say total liabilities. Total liabilities are share capital plus reserves plus current liabilities. So we don't know the share capital figure, but we know the reserves that it is 1,60,000 plus current liability is also computed already as 1,60,000 plus current liability of 1,60,000. This totals to share capital plus 3,20,000. And we know total assets should be equal to total liabilities. Total assets is fixed asset plus 4 lakh is equal to share capital plus 3,20,000. Fixed asset plus 4 lakh equal to share capital plus 3,20,000 total liabilities. So fixed asset is what we have stated as 0.75 share capital plus 1,20,000 is equal to share capital plus 3,20,000. When you put all share capital terms on one side and rest all on the other side, so we can have like 1 lakh. One second, there is some problem. I think 160 plus 160 plus share capital, and on this side we have 4 lakh plus fixed asset, right? When we say, yeah, fixed asset is stated like that. I need to, fixed asset is 0.75 share capital plus 1,20,000 plus 4 lakh is equal to share capital plus 3,20,000. Then we keep all share capital terms on one side, 0.7 minus share capital will be equal to 0.75 share capital minus share capital will be equal to 3,20,000 minus 1,20,000 minus 4 lakhs. That's minus 0.25 share capital will be equal to 320 minus 120 is 2 lakh and then minus 2 lakh. We get the value of share capital as 8 lakhs. Right. So once we get the value of share capital now as 8 lakh, what will be the value of fixed asset? Share capital is 8 lakh. So we know that fixed asset equation, this is maybe our equation number 3. So from 3, we can say it is fixed asset is equal to 0.75 share capital plus 1,20,000. That's 0.75 into 8 lakh plus 1,20,000 is 2 lakh plus 1,20,000, which is 3,20,000. 0.75 is going to be 7,20,000. Okay, so fixed asset is 7,20,000. You can just take a total of. And the balance sheet should tally on its own. Did you get this answer, guys? Yep. Balance sheet is telling it 11 lakh 20,000. Correct? Okay. Then let's take up reserves and surplus is 1 lakh 60. No, I haven't taken 1 lakh 20. That's 1 lakh 60 only. Here you see 1 lakh 20,000 because that is 0.75 multiplied by the entire denominator. Right? Dharni. Okay. Then let's just go for another question. I think you should be able to answer it. So would you like to try it? Would you like to try one question? Yep, guys. What is the word proprietary? Proprietary means own funds. One proprietary means we're talking of own funds. Okay. So let's have a look at this question. I want you to just quickly scribble it. I mean, just try to solve it quickly with pencil. Just try to solve this with pencil quickly, guys. So for that, no, and maybe giving you some timer. Let me just attach a full timer. 7 minutes. Maybe 8 minutes. Yeah. Within 8 minutes, you should be able to solve this question. You can just give it a try. I'll show you the solution later, but first I want you to give it a try. Give it a try, guys. 2 minutes left, guys. I hope you're solving it. Okay, so it's done. Let me get started with the solution. Just like in the previous question, we have the current ratio, we have the net working capital. Use the same relation. Current ratio is current asset upon current liabilities. Net working capital is 3 lakh. And net working capital is current asset minus current liability is 3 lakh. You can definitely say that since the current ratio is 2.5 is equal to current asset upon current liabilities, therefore 2.5 current liability is equal to current asset. Current asset is 2.5 times of current liability minus current liability is 3 lakh. 1.5 times of current liability is 3 lakh. Then current liability amounts to 2 lakh. Once we know that current liability is 2 lakh, you can definitely say current asset is 2.5 times of current liability, which is 2.5 into 2 lakh. So current asset is 5 lakh. Okay, current liability 2 lakh. Current asset is also, current asset is going to be 5 lakhs. Now, current asset 5 lakh, current liability is 2 lakh. Then the next ratio, we can say we have a net working capital number. Liquid ratio is given. From this liquid ratio, we can definitely get the amount of stock. Say liquid ratio is 1.5. Liquid ratio is 1.5. So therefore, we say it is current asset minus stock upon current liability is 1.5. So current asset is 5 lakh minus stock is something which we don't know. Current asset minus stock upon current liability is 2 lakh. is 1.5. That's going to be 5 lakh. 5 lakh minus stock is 3 lakh. The value of stock is going to be 5. Okay. As far as the balance sheet is concerned, fixed asset, current asset, let it in full. Fixed asset, we have current asset. Then on the other side, we have shareholders' net worth and reserves. Like share capital, and reserves. Do we have any debt over here? No, there doesn't seem to be any debt. Okay, so we got the current asset value to be 5 lakh. Then the average debtor collection is also there. So probably we'll have in our balance sheet under current assets, we will have stock, receivables, and others. Current liability, there's no such bifurcation, there's no such distribution is given to us. Stock is 2 lakhs, sorry, 2 lakhs. We can simply say it has a one line item, which is current liabilities. Fixed assets. Okay, got the stock given to us. Now, stock is calculated over here. I mean, stock turnover is calculated as cost of sales upon closing stock. So let us use this stock. Let us use this stock as stock turnover. Now, stock turnover is cost of goods sold upon average stock. So stock turnover is 6. COGS is something, COGS or cost of sales. That is something which we don't know. Cost of sales upon average stock, we'll just take it as same number as stock because we don't have any information about opening and closing. We can say cost of sales or cost of goods sold in our case will be 12 lakh. Okay. Now, why do we need this cost of sales? Because we need to calculate the amount of debtors. Now, the value of debtors can be computed using average debt collection period, which is 2 months. Now, for that, I will need the value of sales. For that, I'll need the value of sales. I need the value of sales. So we know the gross profit ratio. Gross profit ratio is 20%. Gross profit ratio is 20%. Then we say, since your gross profit ratio is 20%, can you tell me what will be the COGS ratio? Can you tell me this? If the gross profit ratio is 20%, what will be the COGS ratio? COGS will be 80%, right? So sales is going to be 12 lakhs divided by 80%. How much is sales working out? What's the value of sales? What is the value of sales working out? 12 lakh divided by 80%. 15 lakhs. Okay, so sales is going to be 15 lakhs. Now, based on this sales, we can calculate the value of debtors or receivables for us. Average debtors collection period is 2 months. Now, we have been given debtors collection period is 2 months. How do we compute this debtors collection period of 2 months? This is computed as sales, or this particular debtors collection period of 2 months is computed as average debtors upon credit sales. So instead of that, we are just taking it as sales into 12. Average debtors upon sales into 12. So what will be the value of average debtors? Average debt collection period is 2 months. And we know the sales figure. Sales is 15 lakh. So average debtors upon sales of 15 lakh into 12 is equal to 2. Average debtors will be 15 lakh into 2 by 12. कितना होता है ये? How much is this? 15 lakh into 2 by 12. Value of debtors 2 lakh 50. Average debtors is 2 lakh 50,000. Or we can simply take the uh, closing itself as 2 lakh 50. And we've got the inventory stock is 2 lakh. What will be the other current assets value? Other current assets value 50,000. That's like a balancing figure. We use stock turnover. We have used the average debt collection period. Now let's come to the current. We have current liability also, right? Current liability is 2 lakh. Yeah. Current liability is 2 lakh. The next aspect or next ratio that is left out is fixed asset to shareholders net worth is 0.8. We have fixed asset to net worth. Fixed assets to net worth is 0.8. Fixed assets to net worth is 0.8. So how much is going to be the fixed asset? We don't know, sir. Net worth also we don't have any idea, because there also we have share capital and reserves, no difference numbers. Fixed asset upon net worth. So I can simply say that fixed asset is 0.8 times of net worth. So we can get this net worth value and fixed asset by taking the total of asset and total of liabilities. We'll say total assets, value of total assets will be fixed asset plus current asset. So fixed asset is 0.8 net worth plus current assets is 5 lakh. Then total liabilities will be net worth plus current liability. And we just net worth plus the current liability amount is 2 lakh. Okay. Then we say, since total assets equal to total liabilities, Total assets is 0.8 net worth plus 5 lakh equal to net worth plus 2 lakh. Let's just bring all the net worth numbers one side. So that will be 0.2 net worth equal to 3 lakh. So how much will be net worth? Will be the amount of the net worth 3 lakh divided by 0.2. 3 lakh divided by 0.2. So the value of net worth stands as 15, right? Now against that 15 lakh, we've got a ratio. What a ratio as reserves and surplus to capital is 0.5. Okay. We say reserves plus capital. Reserves and surplus to capital is 0.5. Reserves and surplus to capital is 0.5. So now this reserves reserves is to capital, right? Reserves and surplus to capital is 0.5. So reserves and surplus to capital, reserves to capital ratio is 0.5. So this is going to be reserves will be equal to 0.5 times of capital. Net worth is 15 lakh. Net worth, if it is 15 lakh, we can say net worth stands as capital plus reserves is 15 lakhs. So let's just substitute it over here. So, I mean, in place of reserves, capital plus, in place of reserves, it's going to be 0.5 times of capital equal to 15 lakhs. 1.5 times of capital is 15 lakhs. What will be the value of capital? Share capital will be 10 lakhs, right? And the capital is 10 lakhs. So we get the reserves as 15 lakh total net worth. From that, you're going to subtract the 10 lakh as the capital. So reserves stand as 5 lakh. So in the balance sheet, you just fix up the share capital as 10 lakh, reserves as 5 lakh, right? Now, what is the value of fixed asset? We have written the value of fixed asset also. Fixed asset is 0.8 times of net worth. So that's 0.8 times of net worth is 15 lakhs. 0.8 into 15 lakhs. That is 12 lakhs. Fixed asset is 12 lakhs. Okay. So the balance sheet tallies at 17 lakhs. Did we all get it? You will get this balance sheet, everyone. They'll be able to solve it. In stock turnover ratio, how you took closing stock of 2 lakh as average stock? There's no information given in the stock turnover. So average stock is assumed to be same as the closing stock. Right? Because otherwise we don't have the information to compute average stock. How to compute share capital? Share capital was simply the difference, because your net worth is 15 lakh. Out of that 15 lakh, your capital is 10 lakh. And so of course, the balance is going to be 5 lakh. It's like we just substituted. Reserves is 0.5 times of capital. So you just place reserves over here. Capital plus 0.5 times of capital is 15 lakh. Capital plus 0.5 times of capital is 15 lakh. So 1.5 times of capital is 15 lakh. Capital is going to be 10 lakhs. Can we take 360 days instead of 365 for calculating turnover? Preferably not, Dharmi, because if the question specifies 360, then only you take 360. Otherwise, you have to always take it as 365 or the months or weeks, whatever is happening. Okay. Yeah. So now we've done a couple of questions. You guys have any sort of queries in today's session? How much marks in exams from this chapter? Well, you're giving a CA exam, so you can't be expecting about marks and all. But yeah, the marks of questions may range anywhere from 4 marks to even a 8 marker you can get. There's no weightage, standard weightage as such. Maybe from 4 marks to range all the way up to 8 marks also. Okay. Any queries, any ratios, or any question? Yep. Two more questions in the next class. Yes, definitely. I'll be taking more questions. Now, just calculate. We have some more time. Can we just calculate these ratios, guys? The questions that you see, and the ratios that you can work out. Calculate these ratios quickly. Current ratio, liquid ratio, stock working capital, capital gearing, stock turnover. Try to get these ratios. What is the current ratio? Current ratio will be total of current assets, which is this entire thing, divided by current liability, which will comprise of this. So what's the current ratio number? Total of this, which is 10 lakhs upon current liability is 4 lakh, which is 2.5 times, right? Current ratio is 2.5. Liquid ratio will be, of course, 10 lakh minus 3.8 minus 0.6 upon 4 lakh. 10 lakh minus 3.8 minus 0.6. How much is this liquid ratio? 1.4. Perfect. 1.4, 1.55. That will be 10 lakh minus 3.8 minus 4.6. 5.6 divided by 4 is 1.4. Correct? 1.4 is the liquid ratio. Now, stock to working capital ratio. So for that, the working capital will be, I mean, working capital is 6 lakh and stock is 3.8. Stock to working capital 3.8 divided by 6. Stock to working capital. So with stock to working capital, so 0.63. Okay. Then capital gearing ratio. Capital gearing ratio will be debentures, which is 1,60,000 plus 3 lakh which is preference share, upon 6,40,000 plus 60,000 plus 2 lakh plus 20,000. How much is this particular number? Capital gearing ratio. Capital gearing ratio 1,60,000 plus 3 lakh. This 4,60,000. 4,60,000 divided by 920. So capital gearing ratio is 0.5. Now for stock turnover and debtors turnover, you have to take the average figures because we have the stock number opening and also the closing stock. So first you need to get the average stock. So how much is the average stock number? How much is average stock? What is the value of average stock? 3,80,000 plus 1,20,000 divided by 2, which is 2,50,000. Average stock is 2,50,000. And what is the stock turnover? So stock turnover, for that we need uh, the sales figure. Sales is 20 lakh, gross profit is 25%. COGS is 15 lakh. Stock turnover will be 15 lakh divided by 2,50,000. 6. 6 will be the answer. Is P&L considered denominator of capital gearing? Yes, P&L is a reserve, right? So stock turnover is 6. Can you tell me what is the debtors turnover? Debtors turnover, we know the sales is 20 lakhs and average debtors will be 360 plus 40, which is 4 lakh. So this is 2 lakh. 20 lakh divided by 2 lakh. So that's debtors turnover is 10 times. Debtors turnover is going to be 10 times. I hope you're clear with these problems. Yep. Good with these examples that we have done. We'll do more of such questions in the upcoming session. That is this PDF? The question PDF, yes, it should be available. Or else I'll just check once again. If that's not available, I'll upload it again. Also, the Excel file with formula will be also available. So I'll make sure that both of them are uploaded right after today's session. With that, let's just stop it for a day. We'll just take it up in the next class. Okay. Till that time, let's just stop here. Bye bye. Take care and good night, guys.